Hello everyone, my name is Indranil Guha and I am one of the co-founders of Finpeg. Today we are going to talk about the Finpeg Lumpsum Investment Strategy. This is a strategy that has been developed completely in-house at Finpeg and is designed specifically for lump sum investments. Now, in case of lump sum investments, the risks associated with the investments are significantly higher. And that's because, unlike in case of SIPs, where the total investment corpus comes in a staggered fashion over a very long period of time at monthly intervals, and in the process, there is an inherent averaging that is built into the investment. There is no such averaging in case of a lump sum investment. And that's what increases the risk of a lump sum investment. Now, when it comes to lump sum investments, the most preferred approach is what is called the buy and hold approach. So what you basically do in buy and hold is you select a bunch of top rated equity mutual funds and you invest your lump sum investment corpus in that portfolio of top rated funds, and then you hold that investment for a very long period of time. And the hope and belief is that when you buy and hold for a very long period of time, usually you will get out with very good returns. Let's see if this really works or not. What you see on your screen right now are the returns of a 5-year lump sum investment into the Nifty over various different 5-year periods since April 2003. As you can see on your screen, the average return of a 5-year lump sum investment into the Nifty since April 2003 has been 12.4% per annum. Now, that in itself is a fairly good return for an average case return. However, by definition, that means that during some of the 5-year periods, the return generated by a lump sum investment into the Nifty was more than 12.4% per annum, and during some of the 5-year periods, the return was less than 12.4% per annum. So, for example, if you invested between the periods May 2003 and May 2008, you would have generated a staggering return of 41.67% per annum. However, if you are unlucky to invest in the Nifty between the periods November 2007 and November 2012, your returns would have been as bad as negative 1.18% per annum. Just imagine, you stayed invested in the Nifty for a period of 5 long years. That's not very short, and yet you ended up with negative returns. Why did this happen? This happened because you had a very steep crash in the Nifty during the course of this 5-year investment cycle. As we know, the Nifty had a 60% correction between 2008 and 2009, and as a result of that, the Nifty's return between November 2007 and November 2012 was practically flat. And this is the risk that you carry when you invest as per a buy and hold approach into equity mutual funds, even for periods as long as 5 years or longer. If, let's say, you are trying to save up for a goal that is due in the next 5 years, and for that you make a lump sum investment today, and during the course of the next 5 years, we, let's say, get a very steep crash in the Nifty, something of the order of what we saw back in 2008, you run the risk of ending up potentially with negative returns, which would invariably mean that you will probably not be able to achieve the financial goal for which you are trying to save up for. So how do you address this risk? At Finpeg, we have designed the Finpeg Lump Sum Investment Strategy to address this very risk. Unlike a buy and hold investment approach, where you invest in your choice of equity mutual funds and leave the investment undisturbed for a very long period of time without trying to time the markets, in case of Finpeg Lump Sum Investment Strategy, we in fact try to actively time your investments into the equity markets. Now, when I say that we try to actively time your investments into the equity markets, I'm not trying to suggest that we have some kind of a crystal ball which tells us how the markets are likely to behave in the days and months to come. All we are suggesting is that we track a bunch of key market parameters that have historically been a very accurate indicator for deciding whether the equity markets are overvalued or undervalued by historical standards. And accordingly, we try to gauge whether the markets are likely to go up or go down in the days and months to come. And if you are able to do this assessment accurately, there is a very good chance that we will be able to time your investments into the equity markets. So let's see how this is done and what are the specific parameters that we make use of as we try to time your investments into equity markets. The first parameter that we make use of is called the price to earnings ratio of the Nifty, or in short, the PE ratio of the Nifty. Now, if you do not know what the PE ratio means, we have put links in the description section of this video through which you can read up more about the PE ratio. What you see on your screen right now is a chart which tracks the movement of the Nifty over the last 20 years. What you also see in the upper half of your screen right now is a chart which tracks the movement of the PE ratio of the Nifty over the last 20 years. As you can see, the average PE ratio of the Nifty over the last 20 years has been 20.01. The highest that the PE ratio of the Nifty has gone to in the last 20 years is 29.9. The lowest that the PE ratio of the Nifty has ever gone to in the last 20 years has been 10.68. What these two charts also show you is that whenever the PE ratio of the Nifty goes to levels significantly higher than its long-term average, those are times when the Nifty is considered to be very, very expensive. And incidentally, those are also the times when the Nifty has experienced some of its biggest corrections. So as you can see, when the PE ratio of the Nifty went above 28 for the first time in the history of the Nifty back in February of 2000, what followed over the next 1.5 years was a correction of 51% in the Nifty. The second time the PE ratio of the Nifty went above 28 was back in January of 2008, and what followed over the next 10 months was a correction of 60% in the Nifty. By the same logic, when the PE ratio of the Nifty drops to levels significantly lower than its long-term average, those are times when the Nifty is of course very, very cheap, and incidentally those are also the times after which the Nifty has rallied very, very strongly. So for example, when the PE ratio of the Nifty dropped to a low of 12.3 back in September of 2001, what followed over the next 6 years, 3 months was this gigantic rally which took the Nifty up from about 850 points in September 2001 to almost 6,300 points in January of 2008. In terms of annualized returns, that translates to almost 37% return per annum. The next time the PE ratio of the Nifty dropped to these super low levels was in October of 2008, when the PE ratio of the Nifty dropped to an all-time low of 10.68. And what we have had since then is this rally which has been on for last 11 years, and during this time the Nifty has gone up from 2,500 points back in October of 2008 to its present level of more than 12,000 points. So as you can see, there is a very high risk of a correction in the Nifty whenever the PE ratio of the Nifty goes to very, very high levels, and whenever the PE ratio of the Nifty drops to very, very low levels, there is a very strong probability that the Nifty will go up. And this historical behavior of the Nifty can be used to very effectively time our investments into equity markets. All you need to do is, whenever the PE ratio of the Nifty shoots to very, very high levels, during such times, you aggressively reduce the weightage of equity funds in your portfolio and move all the investments into safer investments like debt funds. And whenever the PE ratio of the Nifty drops to very, very low levels, those are times when of course the Nifty is now very, very cheap. During such times, you aggressively increase the weightage of equity funds in your portfolio. Let's see how this can be incorporated in your lump sum investment. So in a buy and hold investment approach, you invest your total investment corpus in a bunch of top rated equity mutual funds, and for the entire duration of the investment, all the investments stay in only the equity funds at all times. Instead of doing that, what we propose to do is to actively churn your portfolio between equity funds and debt funds during the course of the investment cycle based on the prevailing PE ratio of the Nifty. To be more specific, what we are proposing to do is, during times when the PE ratio of the Nifty drops to 15 or below, we propose to move the entire investment corpus into equity funds. And as the PE ratio of the Nifty starts to go up, the Nifty is now of course becoming more and more expensive, we propose to reduce the weightage of equity funds in your portfolio and increase the weightage of debt funds in your portfolio. And finally, if and when the PE ratio of the Nifty goes above 25, now the Nifty is of course very, very expensive, we propose to reduce the weightage of equity funds during such times to 0 and move the entire investment during such times to a debt fund. For the purpose of this illustration, the equity fund that we have selected is the Nifty itself, and the debt fund that we have selected is the HDFC Liquid Fund. Now let's see if we incorporate market timing and dynamic asset allocation based on the prevailing PE ratio of the Nifty, what is the impact of that on a lump sum investment of 5 years. What you see on your screen right now are the returns of a 5-year lump sum investment into the Nifty over various different 5-year periods since April 2003, had you incorporated market timing and dynamic asset allocation based on the prevailing P ratio of the Nifty. As you can see in this case, the average return of a 5-year lump sum investment into the Nifty improves to 16.85% per annum. That's a phenomenal return to have for a 5-year lump sum investment in the average case. More importantly, even in the worst case scenario, a 5-year investment into the Nifty has generated a return of 9.94% per annum. That would have been realized between the periods of April 2014 and April 2019. Let's see how these performance numbers compare with a 5-year lump sum investment into the Nifty without any market timing that we saw a little while back. As we saw a little while back, the average case return of a 5-year lump sum investment into the Nifty has been 12.4%. That improves to 16.85% when you incorporate market timing and dynamic asset allocation based on the prevailing P ratio of the Nifty. More importantly, the worst case return of a 5-year investment into the Nifty has been negative 1.18% per annum, and that improves to a staggering 9.94% per annum when you incorporate market timing based on the prevailing P ratio of the Nifty. As you can see, this marks a dramatic improvement in the performance of a 5-year lump sum investment into the Nifty. Now, these are of course historical performance numbers, and one should not construe them as any kind of indication or assurance of future returns. But I hope you would agree with me that these numbers at least do demonstrate the humongous potential of improving the performance of a 5-year lump sum investment into the Nifty by incorporating market timing and dynamic asset allocation based on just one market parameter, which is the P ratio of the Nifty. Just imagine what happens when you incorporate more such parameters other than the P ratio, and that's exactly what we seek to do as part of the Finpeg Lumpsum Investment Strategy. In the Finpeg Lumpsum Investment Strategy, we do not depend only on the P ratio of the Nifty. Instead, we depend on a comprehensive basket of input parameters. Why do we do that? We do that because if you try to time your investments into equity markets based on only the P ratio of the Nifty, you're likely to get it wrong at least some of the times. For example, as we record this video in January of 2020, the P ratio of the Nifty has been above 28 for the most part in the last 2 years. And yet, we haven't really seen a 50-60% correction in the Nifty in the last 2 years. What does that show you? That shows us that just because the Nifty has corrected by 50 to 60% in the past, whenever the P ratio of the Nifty has gone above 28, that doesn't necessarily mean that Nifty will continue to behave in exactly the same way going forward as well. And hence, if you're trying to time your investments into equity markets, it's imperative that you use not just the P ratio, but a far more comprehensive basket of input parameters to time your investments into the equity markets. So what are the other parameters that we make use of as we try to time our investments into equity markets? There are broadly 5 sets of input parameters that we make use of, and these 5 sets of input parameters are listed on the screen right now. The first set of input parameters that we look at is related to the valuation of Indian and US markets. So basically what we look at is the PE ratio and the price to book ratio of the Nifty 50 here in India as well as S&P 500 in the US. The second set of input parameters that we look at concerns the government bond yields and corporate bond yields here in India as well as globally. The third set of parameters that we look at covers macroeconomic indicators, basically the GDP growth rate and inflation rates here in India as well as globally. The fourth set of parameters that we look at is related to global economic activity. Now, there's a whole bunch of economic parameters that track global economic activity. The specific parameter that we look at as part of the Finpeg Lumpsum Investment Strategy is called the ECRI. Last but not the least, the fifth set of input parameters that we track as part of the Finpeg Lumpsum Investment Strategy is the monetary policy of global central banks. To be specific, we look at the monetary policy of the US Federal Reserve, the European Central Bank and the Japanese Central Bank. Now, the last set of input parameters is something that probably requires a little more elaboration. Why is that? As we saw a little while back, when you look at the equity markets through the prism of P ratio of the Nifty, the markets are probably very, very overvalued at this point in time. And that probably means that we should stay out of equity markets as we record this video. However, if you look at the markets through the lens of the monetary policy of global central banks, there is probably a case to be made that there is potential for the Nifty to go up significantly from these levels, despite the fact that the Nifty is already very, very overvalued. And why is that? That is because as we record this video in January of 2020, global central banks in general and the Federal Reserve in particular are engaging in a policy called balance sheet expansion. Now, what is balance sheet expansion? So when the US Federal Reserve engages in balance sheet expansion, what is effectively happening is that it starts printing dollars and starts pushing out these newly printed dollars out into the US financial system. The effect of that is total money supply in the US financial system starts to go up. These newly printed dollars start to find their way into the hands of investors, and investors in turn invest these newly printed dollars back into equity markets and bond markets. And as a result, it's been historically seen that whenever the Federal Reserve engages in balance sheet expansion, you have equity markets and bond markets starting to rally very, very strongly. The US dollar, of course, is a very special currency. It's the reserve currency of the world. So when the Fed does money printing, the circulation of these newly printed dollars are not limited only within the US system. In the form of FII flows, these newly printed dollars also find their way into emerging markets, including India. So as a result, it has been historically seen that whenever the Fed engages in money printing and balance sheet expansion, you have equity markets from US all the way to India, everything starts going up. And this is something that becomes very, very clear when you look at the chart on your screen right now. As you can see, between January of 2018 and September of 2019, the Federal Reserve Bank of US was actually contracting its balance sheet size. So the balance sheet size of the US Federal Reserve went down from $4.5 trillion back in January of 2018 all the way down to $3.6 trillion by September of 2019. So that's a reduction of $900 billion. That's the amount of dollar liquidity that was sucked out of the global dollar pool. And after September 2019, the Federal Reserve reversed policy and the size of its balance sheet again started to grow. And as you can see, between September 2019 and January 2020, the size of the US Federal Reserve's balance sheet went up from $3.6 trillion to its present level of about $4 trillion. What has been the impact of this on equity markets here in India? As you can see in this chart, between the period of January 2018 and September 2019, when the Federal Reserve was actually contracting the size of its balance sheet, equity markets here in India had a very, very volatile phase. The Nifty went up many times, but it also came down as many times. Net, the returns of the Nifty during this 21-month period was practically zero. However, as soon as the Federal Reserve started to engage in balance sheet expansion and balance sheet started to grow from $3.6 trillion all the way up to $4 trillion, the Nifty immediately had a reversal in trend, and what we have had since then is the Nifty rallying very, very strongly by more than 15% since September of 2019. And it's not just the Nifty, you could have picked up any equity market around the world and everything has gone up between 12 to 15%. So as you can see, some of the parameters that we track are indicating that the markets are very expensive and we should possibly sit out of equity markets at this stage, while some of the other parameters that we track are suggesting that there is further room for the equity markets to go up still, despite the fact that equity markets are already very, very overvalued. And this is where our role comes in. We distill these often conflicting signals emanating from various market parameters that we track and accordingly make an informed choice with respect to what should be the optimal asset allocation for our client portfolios at any given point in time. And that's exactly what we seek to achieve through the Finpeg Lumpsum Investment Strategy. Before concluding, I would like to talk briefly about how the Finpeg Lumpsum Investment Strategy is actually executed. As we discussed, the Finpeg Lumpsum Investment Strategy is all about continuously churning your portfolio between equity funds and debt funds as per a logic linked to the 5 sets of input parameters that govern the Finpeg Lumpsum Investment Strategy. So when you are setting up a Finpeg Lumpsum Investment Strategy involving 3 top-rated equity mutual funds, What you also need to have in your portfolio are 3 debt funds corresponding to the 3 equity funds. So the way this works is that the initial investment corpus has to be first invested in the 3 debt funds in the portfolio, and then the Finpeg Lumpsum Investment Strategy's investment algorithm takes over and it starts churning your investment corpus between the 3 debt funds and the 3 equity funds. Now, when you continuously churn your portfolio between equity funds and debt funds, there is a possibility that the mutual funds concerned could impose an exit load on your investments. And this is something that we should ideally try and avoid. Now, when you move your money from debt funds into equity funds, usually there is no exit load. However, once the money is invested in equity funds, and if you try to get out of that investment in less than 1 year's time, most mutual fund companies impose an exit load of up to 1%. And this is something that we should ideally try and avoid. So as part of the Finpeg Lumpsum Investment Strategy, we have built this intelligence into the investment algorithm that once an investment is deployed into equity funds, we usually do not pull that investment back out of equity funds in less than 1 year's time. This ensures that to the extent possible, we do not incur the exit loads that is applicable when you get out of equity investment in less than 1 year's time. One last word on the debt funds that we make use of as part of the Finpeg Lumpsum Investment Strategy. Now, wherever possible, we do not use debt funds per se. Instead, we make use of this category of funds called arbitrage funds. Arbitrage funds are a category of funds whose returns are similar to that of debt funds. However, the tax treatment of arbitrage funds is similar to that of equity funds. As a result, for most investors, the post-tax returns of arbitrage funds works out to be better than debt funds. And hence, wherever possible, we make use of arbitrage funds instead of debt funds. However, we may not have a choice in all cases because not every fund house offers an arbitrage fund. So if we are setting up a Finpeg Lumpsum Investment Strategy using an equity fund of any such fund house which does not offer arbitrage funds, we will have no choice but to stick to a debt fund. This brings us to the end of this video. Hope you liked it. If you have any further queries on the Finpeg Lumpsum Investment Strategy, please reach out to us on the phone number and email address shown at the end of the video. Thank you for watching this video.
If you liked our video, please subscribe to our channel and don't forget to press the bell icon because we'll be adding new content regularly.